Okay. There are 19 days left before your final project is due. I don't mind to freak you out, but just I know you're all moving and you're moving as fast as you can. I'll just keep a running count from this session on. So next session I'll say so there'll be 14 days left, obviously by Monday, but the clock is ticking. So I just want to. The other thing is, and while you're working on the project, you don't want to be reminded of this. A week from today is your last quiz. It'll cover just capital structure, which we pretty much will be done with today, right? Halfway through today, we'll be done with everything for the last quiz. And after class today, when I send you my email, I'll send you, I did the review webcast last night, so I'll put the link up to it, plus the past quizzes, and you can try your hand at the last quizzes. Any questions before we start? Okay, so we were talking about the design of debt on Monday, and the basic principle is a very simple one. Go back to it whenever you're in doubt. What's your objective? What's your perfect debt going to look like? It's going to get you all the tax benefits of debt, but it'll look like equity, right? It'll give you all the flexibility of equity with the tax benefits of debt. And you're bending every single rule to get there and hoping that you don't break the rules. We talked about a couple of ways you can design debt. The first is intuitive, and I think it remains the most powerful way of thinking about debt. Think about what kind of projects your company takes, and then try to design debt based on those projects. The second way we looked at designing debt was to extend your capital budgeting one extra step, which is if you have the expected cash flows on your project, like you did for the Disney theme park, you can take those cash flows and use those cash flows as your basis for deciding how long-term should your debt be, what currency, etc. But that second approach works only if your projects tend to be large standalone projects and take on their own debt. But in most companies, that's not the case. The company borrows money to finance a portfolio of projects. So the third approach is designed for those kinds of companies, and those will be most of the companies you look at. And you're saying, well, what kind of debt is right for my company? So I'm going to go through a framework, a quantitative framework for deciding the right kind of debt for your company, looking at its history. Okay? So I left you with this page where I looked at, first I looked at Disney's historical data, and I looked at two numbers. I looked at the operating income over time to see its earnings and what happened to it over time, and the market value over time. So I have two measures of success here. One is, what is my company doing in terms of earnings? And the second is, what does the market think about it going forward? And then I said, I'm going to relate those percentage changes, earnings and value, to macroeconomic data. Changes in interest rates, changes in real GDP, changes in inflation, changes in the weighted dollar. So what we're going to do now is take the numbers for Disney and see if there are any clues in the macroeconomic data that we can use to design debt better. So let me start with the first thing I'm going to test. I'm going to look at how Disney's income and value changes as interest rates change. And I'm going to argue that when I look at that relationship, I'll get a measure of what the typical duration for Disney's assets are. It seems like there's a disconnect. You're saying, how will that tell me? I'm going to take you through the process of, and that's going to tell us what kind of debt, how long-term our debt should be. So here's what I did. I ran a regression of changes in Disney's value. So I have 30 years of data. I took the changes in Disney's value over time and ran a regression against change in the T-bond rate. So how do you read this coefficient? First, for every 1% change in interest rates, Disney's firm value decreases by 2.39%. But before you get too excited, the T statistic tells you it's not a particularly strong relationship. Now I'm going to make a statement and I'll back this up. This coefficient tells you something about the duration of your assets. In fact, if that coefficient were viewed as statistically significant, Disney's assets have roughly a duration of about 2.4 years. When you did foundations and you did duration of bonds, right? Duration of, what is the duration of a bond measure? First, it gives you a weighted maturity, right? Basically, if you look at it, it's a weighted maturity of when your cash flows come due. If you have a 10-year bond with coupons, your duration is going to be less than 10 years. It's going to be weighted towards 10 because the biggest cash flow. So in duration, it's a weighted average of the cash flows. But another reading of duration is it tells you how sensitive your bond is to changes in interest rates. In fact, the classic measure of duration looks at the percentage change in your bond for a percentage change in interest rates. So when I tell you the duration of a bond is 7.4 years, I'm also telling you that if interest rates change by 1%, your bond price will drop by 7.4%. I know we don't read it that way, but that's what duration tells you. So the duration of a bond tells you how much a bond price changes for every 1% change in interest rates. Tell me what the regression tells you. For every 1% change in interest rates, this is how much my firm value changes. I'm answering the same question using a different approach. So when you think about traditional bond duration, you think about computing the duration based on the cash flows and the maturity. And you think about computing how sensitive your bond price is to a percentage change in interest rates. I'm accomplishing the same thing with the regression. In fact, I'm going to argue there are two ways you can compute duration. One is to do with the traditional bond way, we're looking at expected cash flows or coupons and backing out from it. The other is to do what I just did, run a regression. The advantage of the second approach is I don't need future cash flows. I can do this with historical data running a regression. So I'm going to run the regression, and that regression coefficient is going to tell me, roughly speaking, what the duration of Disney's assets is. But only if the coefficient is negative, because remember, the duration measures how much my bond price drops when interest rates go up. So you're saying, what if the duration is 0? Well, then basically your assets have 0 duration. They're very short term. What if it's positive? I don't even know how to read a positive coefficient. I'm just going to say it's noise, and I'm going to move on. But if I run a regression, I get a negative coefficient, and that coefficient is statistically significant. I've got at least a proxy for the duration of my company's assets. I also ran the regression using operating. With all my regressions, I'm going to run the regression with both firm value that looks at how much my value has changed and how much income has changed. And each is going to give me some useful information in designing debt. So when I run the regression of changes in operating income against changes in interest rates instead of firm value, I come to the conclusion, here you're getting marginally significant. 1.4 is not something to get excited about, but it's higher than the 0.37. Every 1% increase in interest rates decreases my operating income by about 7.4%. So when interest rates go up, it's not good news for Disney. Their operating income drops by roughly 7.4%, but their firm value decreases by less, only about 2.4%. So I'm learning something about Disney looking at its history. The second regression I ran is a much more straightforward one. I ran a regression of changes in value and earnings against changes in real GDP. Think about what this regression tells you. If the coefficient is positive, it basically means when the economy is stronger, I do well. My earnings go up and my value goes up. If the coefficient is 0, it tells me that my company is unaffected by what happens in the economy. And if the coefficient is negative, and I trust that coefficient, I actually have a counter-cyclical company, a company that does well when the economy does badly, and badly when the economy does well. So again, you're running the regression of changes in value and changes in earnings against GDP, and it's going to give us a sense of how much we should borrow, because if you're a cyclical company, you've got to be careful about borrowing too much, and also whether we might be able to bring some features into the debt to protect us from economic cycles. So let's say Disney is a cyclical company. When I regress changes in firm value against changes in GDP growth, every 1% increase in real GDP growth increases my value by 6.7%. And the T statistic is definitely significant. So Disney's value increases. So what does it tell us about Disney? Disney, it looks like it is a cyclical company. That has not always been true. When I ran this regression the first time in 97, Disney's value was relatively unaffected by the economy. Over time, it has become more cyclical, perhaps because it has a larger stake in the movie and the entertainment business. It used to be a theme park company with a few movies every year. It's become a little more cyclical. And when I run the regression against earnings, I get a very similar result. Every 1% increase in real GDP growth increases my earnings by about 6.6%. The bottom line is both these regressions suggest that Disney is a cyclical company, and therefore when I design debt, I should be a little careful about how much debt I take on. And if I want to bring in features, I want to bring in something that protects me if the economy is in a recession. Third regression I ran was I ran a regression of Disney's change in firm value and change in earnings against changes in the dollar. Initially, I tried running it against each currency, dollar, euro, and then it got tiresome because there are dozens and dozens of currencies I can run it against. And here, this measure of the weighted dollar comes in. This is not a number I compute. It's a number that the Federal Reserve has computed over time. And it's a measure of, is the dollar getting stronger or weaker over time against all currencies. So again, when you run this regression and you get a positive coefficient, here's what it tells you. When the dollar gets stronger, you do much better if you have a positive coefficient. If you get a negative coefficient and the dollar gets stronger, you get hurt. And you can see stories as to why both might happen with companies. And the coefficient is 0, you're relatively unaffected. Why do we care? If you are affected by a stronger or a weaker dollar, it means that you should have some foreign currency debt, because every time the dollar moves, you're affected as a company. So it's kind of contradictory, because both positive and negative, as long as they're significant, mean you need more foreign currency debt. It's only if you get a coefficient of 0 that you can say, I don't care, I might as well go with the US dollar debt. So again, let's look at what Disney's numbers look like. When I look at the change in firm value, there is, when the dollar gets stronger, Disney's value drops, but the change is not statistically significant. The T statistic, again, is only 0.57. But earnings are much more sensitive to change. A stronger dollar is bad for Disney. And you can see why, right? When the dollar gets stronger, what happens? Fewer people come to the theme parks. So in a sense, a stronger dollar still cuts against Disney. That doesn't always have to be true, but in this case, it cuts against Disney. What does that tell me? If I look at these regressions collectively, I would want Disney to have some foreign currency debt. It is affected by movements in the currency. So we've looked at interest rates, we've looked at the economy, we've looked at the weighted dollar. Last regression I ran was against inflation. And here, when I look at the coefficient, I'm getting a sense of pricing power, and here's why. If as inflation goes up, I'm able to increase earnings, and especially with earnings, my earnings go up proportionately, I have pricing power. If as inflation goes up, my earnings don't go up, I get a coefficient that's either 0 or negative, I don't have pricing power. Why does it matter? Last session I talked about the choice between floating and fixed rate debt. If you have pricing power, you're a much better candidate for floating rate debt. Maybe this regression will give me a clue as to that pricing power. So do you think Disney has pricing power? I feel it every time I buy Disney tickets, right? I mean, the prices keep going up. And the results actually confirm it, at least at the earnings level. If you look at the coefficient, every 1% increase in the inflation rate translates into much higher earnings. The value effect is more muted. How come? Even if you can increase your earnings at the inflation rate, your cash flows go up. What else is changing in your value equation? Your discount rate is also going up. So inflation doesn't help Disney in terms of increasing value, but it does mean that they can pass the inflation through to their consumers. So 4 different regressions, and you can see the template you can extend to whatever you want. If this were an oil company, what might you want to run the regression against? Against oil prices. Whatever macroeconomic variable you think affects your company, you run it against that. And you will get a measure of how sensitive your company's earnings and value are to that particular variable. And again, you're doing this because you hope to build something into your debt to protect yourself against that downside. So if I were to summarize these regressions, here's what I find. Disney's assets collectively, if I believe that regression, and I'm a little shaky on that number because the T statistic is so low, have a duration of roughly 2.4 years collectively. That includes all their businesses. Disney is increasingly affected by economic cycles. It's becoming a more cyclical company. It is hurt by a stronger dollar, and it does have pricing power in the sense it can at least pass it through into their income. But with all of these regressions, it's one slice of history, one regression, and the T statistics are incredibly shaky. Does that sound familiar? When you try to estimate the risk in a stock, what do? We ran a regression of returns in the stock against returns in a market index. We got a regression, but then didn't we say exactly the same thing about that regression? One slice of history, it's shaky, and you don't want to. So what do we do with regression betas to get a more solid number? We looked at the sector. We computed bottom-up betas. We used the law of large numbers. Can I do that with this analysis? I don't see why not. I know what businesses they're in. if I can, it's a lot more work because you can't go to Bloomberg and pull these numbers off. So I actually had to take each sector and run regressions for companies in the sector. The regressions are going to have to use annual or quarterly data because the macroeconomic data is not every day. These are the bottom-up estimates for interest rates. So if I ran the coefficients for all the companies and average them out, I'm at least getting the law of large numbers working for me. So how does that help me? If I take a weighted average of those coefficients, I get a bottom-up estimate for each of the coefficients. So if you look at interest rates, if I take the weighted average of the different parts of Disney against interest rates, the weighted average that I get is minus 4.34. What does that tell me? To the extent that I trust this bottom-up number, Disney's assets, roughly speaking, have a duration of roughly 4.3 years. Now, so basically with every coefficient I ran, just make sure the weights add up to 1. These weights are the same weights I use to compute my bottom-up beta. So essentially I'm using those weights now to compute bottom-up measures of what kind of debt I should be designing. So if I take these numbers and before I even look at Disney's balance sheet, here's what I would expect to find given my assessment. First is, I would expect the debt that Disney has to be fairly long term with a weighted average duration of roughly 4.3 years. Duration. I would expect a significant portion of the debt to be floating rate debt because it looks like Disney has pricing power. And I would expect to see a significant portion of the debt be foreign currency debt because it is affected by the dollar. So that's what I expect to see. Then I open up the balance sheet to see what they already have. Here's what I saw when I looked at what they actually had. Their actual debt has a maturity of about 7.9 years. A weighted maturity. That's a maturity, the duration of 4.3. It's probably a little too long term, but not by much. If the weighted maturity had been 75 years or 25 years, that's a little worrying. 7.92, the weighted duration was probably 6 years. I wanted 4.3 given the noise. If the weighted maturity had been 1 year or 2 years, it would be too short term. So the first thing I'm looking at is Disney's debt maturity okay? And my assessment is I can live with this. Then I looked at how much of their debt is foreign currency debt, and they're only about 5.5% foreign currency debt. And here I have a number I can compare it to. 18% of their revenues in 2013 came from outside the US. So the 5.5% looks too low. And it's almost all Hong Kong dollar debt, primarily for the Hong Kong theme park. So basically there's very little, there's some Indian rupee debt because they bought an Indian broadcasting company. So the debt they've taken on is primarily either for a big investment or an acquisition. But the debt seems to be too little foreign currency debt and probably too skewed towards Asian currencies. Okay. They have no convertible debt, and 5.7% of their debt is floating rate debt. Here again, that number seems low given their pricing power. So if I were looking at Disney and making a recommendation, my recommendation is you need more floating rate and foreign currency debt. And if you can get your current debt into that, it'll probably suit you better. And today's day and age, making that change is a lot easier than it used to be. 35 years ago, if you didn't like the debt on your books, here's what you had to do. You had to pay it off and take on new debt, which is an expensive, time-consuming process. Today, you can swap your debt out. You can use options and futures to kind of get back in sync. There is no excuse that most developed market companies have for mismatching their debt. You can get your debt to be more appropriate for you as a company by just using the tools that you have. The other way you can get your debt into sync is Disney has big projects planned, right? So the next big project, what should they do? Fund it disproportionately with foreign currency floating rate debt, and their overall debt will start to look more like the debt they need to be. So I can give them a recommendation on either redesigning their existing debt or going out and issuing new debt. So I'll try this on my other companies, and then I'll give some suggestions when you look at your company as to what you might want to think about doing. I took a look at Bookscape, and before I even looked at the debt, I said, what kind of debt would I expect Bookscape to have? It's a single bookstore in New York City. All the cash flows come in US dollars. They have no pricing power. So if I were designing debt, it should probably be long-term debt and fixed rate debt, right? And if I could link it up to that particular location, I'd like to link the debt up to that location. There's a reason certain kinds of debt evolve in certain sectors. There's a reason retail firms use leases. A lease is a long-term fixed rate debt tied to a location. So I think they've got exactly the debt they need. They've got lease debt, it's tied to the location, it's fixed rate. No, I'm not going to mess with what's already okay. So Bookscape looks okay. Move on. Let's look at Vale. Vale's typical project is a long-term mine somewhere in the world. It could be in Brazil, it could be in Canada, it could be in Australia. Right? So if I were, and all commodity companies sell into a dollar-based market. Right? They don't sell in Canadian dollars or reais, they sell in US dollars. So looking at the characteristics of Vale's projects, I would expect its debt to be long-term, US dollar debt, and if there were any special features, it should be linked to the iron ore price. And that might be asking for much, but that would look like the debt I would expect to see. What I saw was a lot of really long-term debt. Their average maturity of the debt is 14.7 years, much higher than Disney's debt. That makes sense. About 65% of their debt is US dollar debt, which again makes sense. And if there's any mismatch that's happening at Vale, it's because their costs are probably in the local currency and their revenues come in US dollars. And that is probably easier dealt with futures or options or derivatives than to try to bring it into debt. So again, with Vale, the overall debt makes sense. You might finesse a few features. It has no pricing power, so it should not be issuing any floating rate debt because it's going to get squeezed. So you can see the process play out with Vale. It looks reasonably okay. Then I turn to Tata Motors. 20 years ago, if I were designing Tata Motors debt, you know what it would look like? 20 years ago, it was all Indian rupee. Their operation, their entire, they sold every car they sold was in India. It would have been all Indian rupee debt. And now how much pricing power they would have had. And I would probably have expected long-term fixed rate debt. And 20 years ago, if I looked at their balance sheet, what would I have found? A lot of short-term rupee debt. You're saying, why? Because 20 years ago, the only way Tata Motors would have raised debt is to go to a bank and borrow money. And here's one of the problems in emerging markets. Until recently, you had no choice. When you wanted to borrow money, you could go into a bank and say, the right kind of debt for me is 30-year floating rate debt. And the bank says, 3-year fixed rate debt. Take it or leave it. And if you have no choice, you're often stuck with debt that is going to be mismatched. But looking at Tata Motors today, it's no longer an Indian company. In fact, if you remember the revenue breakdown, it gets almost as much revenues from China as it does from India because of the Jaguar Land Rover exposure. So I'd expect a lot of its debt to be long-term and fixed rate, but in a mix of currencies reflecting where it does business. When I looked at Tata Motors debt, about 71% is rupee debt, 29% is euro debt. The average maturity is 5.33 years. The maturity I can live with. The mix you might have to revisit because as Jaguar Land Rover keeps growing relative to Tata Motors domestically, maybe they need to start shifting their debt to foreign currency debt because they're becoming less of an Indian company. They're getting less of their revenues in India. And finally, I looked at Baidu. And we talked about this earlier. Baidu gets all of its revenues in China. If I were expecting to see debt on Baidu's books, it should be short-term debt because it's a technology company. Everything changes quickly. I could live with convertible debt because you could say I'm a growing company, so I would expect short-term, maybe convertible debt. And I would expect the debt to all be in Chinese yuan. And if you look at Baidu's debt, it looks hopelessly mismatched. 82% of their debt is in US dollars and euros, and the average maturity is 5.8 years. Luckily for them, they don't have very much debt, so I'm not going to freak out. It's only 5% of the value. But this debt makes no sense given what they are as a company. So I'm giving you a template for what you need to do in your project. Before you look at your debt, here's what I want you to do. You don't have to do the regressions I ran with macroeconomic data. It's messy. At least intuitively think about what kind of debt your company should have, given the kinds of projects it takes. Then look at its actual debt, and if it's mismatched, at least give me a sense of how you would fix that mismatch. Is it by taking new projects? If it's a company that's growing, taking on more investments, that might be the better way to go. But if it's a mature company, you might have to do something more immediate, where you transfer some of their existing debt with swaps and derivatives to make it debt that matches. I think around the world, this is one of the great opportunities in corporate finance. There are lots of companies with mismatched debt, precisely for the reason we talked about. A lot of these companies had no choice. They went to the bank and the bank said 2-year bank loan, take it or leave it, fixed rate. So they have a lot of 2-year debt on their books because that's what their existing debt looks like. But now they have choices, and those choices can lead them to kind of, you don't even have to change your debt ratio. You're just matching your debt up to your assets much better. And you need to stop using forwards and futures and options constantly as your way. If you can fix something long term by designing debt better, why not do it up front? And then use futures and options as a way of managing the marginal shifts in your, because when you constantly use derivatives, it is an expensive process, and you might end up with debt that's not right for you. Any questions? Yes?
Calculate the cost of having missing correct debt.
Yes, it's a default risk, right? So basically the way it shows up is that default spread we have on the debt reflects how much, so if you have mismatched debt, your default risk is much higher. We don't actually, because we use an interest coverage ratio, we might be missing it. So that might be one of those, if you have an actual rating, it reflects it. But if you're doing a synthetic rating, we're missing it. So if we were doing this right, not only should we look at the interest coverage ratio, we should also look at what currency the interest expense is versus the income. And if it's mismatched, give a company a lower rating. But that's how it shows up in practice. If you mismatch, your default spreads will be higher, your cost of debt will be higher, your cost of capital will be higher. And if you match up better, you can have exactly the same debt you had before, but a lower default spread, a lower cost of debt, and a lower cost of capital. Okay. Any other questions? So we're on to the final piece in corporate finance. So before I start talking about dividends and buybacks, I want to start off with a proposition that's going to push back against what many managers seem to think about cash. If you talk to managers at companies, they talk about our cash, the company's cash. So let me start with the proposition. Companies don't have cash. That sounds like an absurd statement to make. Apple has no cash. It actually is holding $250 billion of its stockholders' cash. So companies are custodians for their owners' cash, which means the onus then should be on managers to justify why they take some of my cash rather than me justifying why I need to get the cash back. I think it's completely backwards for stockholders to have to go to managers and beg them for their own cash. So if you start with that proposition, let's think about the questions that come up in terms of returning cash. There are two basic questions that you face with every business, private or public. The first is, how much cash can I take out of this business every year without affecting its future so the first question is, how much cash should I return? Whether you do it in the form of dividends or buybacks becomes the second question. Should I return it in dividends or buybacks? So those are the two questions. Implicitly, there's a third question we're asking as well, which is, how much of a cash balance is too much of a cash balance, right? Because when you talk about how much cash you should return, you're also talking about how much cash should I leave behind. Now, the answer to that last question is not as obvious as it sounds. Does Apple have too much cash? You say, of course, $250 billion. We're going to see that how much cash you have doesn't affect how much push I get to get the cash back. This part of corporate finance, more than any other aspect of corporate finance, is built on trust. Trusting who? Trusting the managers with your cash. I'm going to argue that if you trust the management of a company with your cash, you're much more likely to leave cash in a company because you're not worried about it getting wasted. So let's start off by looking at how dividend policy is supposed to work in practice. Here's how dividend should work. Dividend should be the last step in the process, because here's how it begins. You start off by looking at how much cash you generate from operations. You take in projects, the cash flow comes in. From that cash from operations, you got to make debt payments, interest payments, and principal payments. Whatever is left is cash flows available to equity investors. So if you think in terms of the statement of cash flows, you're at the starting point. That's a cash flow. From that cash flow that's available from operations, I decide how much to reinvest back, and that's determined by whether I have good projects or not. So if I have lots of good projects, a reinvestment might take all my cash. But if I don't have enough good projects, then I have cash available to return. And we're going to measure that cash available to be returned to shareholders with what I'm going to call a free cash flow to equity. And every word there is there for a reason. It's free because it's after I've met every conceivable need. Taxes, reinvestment, debt payments. And it's to equity investors because it's after debt payments. So think of that as potential dividend. So that's my potential dividend. Now from that potential dividend, I might choose to hold some cash back in the company and decide that the rest gets paid out. And once I decide how much I'm going to pay out, I have to decide whether to do it in the form of dividends and buybacks. So in a perfect world where you're running a company sensibly, the dividend and buyback decision, the cash return decision, is the last step in the process. So if you're running your own business, it's what you do on December 31st after you met every conceivable need. But here's the problem. More than any other aspect of corporate finance, dividend policy is dysfunctional. It's dysfunctional, A, because the sequence gets reversed. You know what I mean by the sequence gets reversed? Here's what companies do. They decide how much they're going to pay in dividends first. And then everything else they do is driven by that choice. So if you decide to pay a huge amount in dividends, what do you have to do? You have to go out and borrow money. Why? To pay dividends. You don't take projects. Why? Because you paid the dividends. It's not the way it's supposed to be, but in practice it often is. And there are two forces, and these are two forces I've mentioned before that drive dividend policy. The first is inertia. A lot of companies pay dividends because that's what they've always paid. They don't even think about, is this the right amount? And a lot of companies pay dividends because this is what other companies do. That sound familiar? That's how they set debt policy. You could think of corporate finance. 80% of corporate finance is basically copying what other companies do. So as you look at the numbers on dividends, and I'm going to go through what the numbers have looked like over time, keep those two things in mind, because companies often do truly irrational things when it comes to dividends, and then try to fix it by fixing the rest of corporate finance. So I'm going to start off by characterizing what dividends look like. First in the US, then I'll talk about the rest of the world. If there's a word I would use to describe dividends around the world, it's that they're sticky. You know what I mean by sticky? If you ask me how much is my company going to pay in dividends next year, you know what I'm going to do? I'm going to look at dividends this year. In most companies, if you see what your company pays out in dividends this year, it's a pretty good predictor of what you're going to get next year. So if your company paid no dividends this year, my guess is it's going to pay no dividends next year. If it paid a lot of dividends this year, it's going to pay a lot of dividends next year. And I'll back up this statement. This graph, what I've done is every year I've counted the percentage of US companies that increase dividends. That's the first column. The percentage of US companies that cut dividends. That's a purple column. And in the last column, the ugly yellow, is the percent of companies that don't do it, that don't change dividends. And in every single year, including 2008 and 2009, guess which group wins out every single year? The percent of companies that do nothing to dividends vastly outnumber the companies that either increase dividends or decrease dividends. And if you look at the companies that change dividends, which do you see more frequently, increases or decreases? There are about 3 to 4 times as many companies that increase dividends that decrease them. And we'll talk about why that is and what consequences it has when a company gets into a dysfunctional dividend policy. So dividends are sticky. And you can see this especially when you look even during crisis periods. In fact, my test for this was what would happen after the 2008 crisis, because this was one of the worst crises in a century. You would expect companies to be cutting dividends like crazy. And it's true that as you got to the last quarter of 2008, the midst of the crisis, you saw more dividend cuts and dividend suspensions than in most other quarters. But even in that horrifically bad quarter, more companies increased dividends than cut or suspended dividends. If you see that happening in the last quarter of 2008, that is a true testimonial to how sticky dividends are. Incidentally, across the world, this sticky phenomenon applies. So you look at Europe, dividends are sticky. In Asia, dividends are sticky. In Latin America, dividend payout ratios are sticky rather than dollar dividends, which is actually a little healthier. You know what I mean by payout ratios? Latin American companies tend to pay out a percentage of their earnings as dividends and stick with that percentage payout. And one reason for that, in much of Latin America, you're voting and non-voting shares. And the non-voting share voting rights are triggered by how much you pay in dividends. So they're almost kind of locked into paying a certain percent of their earnings in dividends. but it's sticky around the world. Second, dividends tend to follow earnings. Key word here is they follow. They don't lead earnings. They're not contemporaneous with earnings. They follow earnings. And you can see that in the graph. Basically, what I have here are earnings and dividends every year. Notice the dividend stream is a lot smoother than the earnings stream. Earnings go up and down, but dividends have this nice smooth graph. And they follow earnings, which in the sense, if you have a really good earnings year, then you see dividends go up the following year, the year after, not the same year. And if you have a really bad earnings year like 2008, you saw the consequences in 2009, 2010, and 2011. So dividends are sticky and dividends tend to follow earnings. So here's what companies do. They decide what to pay in dividends based on what they did last year. If they have a really bad earnings year, they think about dividends, but they don't cut dividends right away. If they have 2 bad earnings year in a row, they say, maybe we should cut dividends, but they still hold off. 3 bad years, maybe now we should cut dividends. Maybe 5 bad years. So how sticky dividends are varies across companies. And when companies make boasts like, we haven't cut dividends in 107 years, I don't know whether to laugh or to cry. Okay? I remember, I think it was one of the big mining companies. I'm trying to think which one it was. The CEO was asked, this is in 2016. Mining companies' earnings had collapsed. They were losing money like crazy. They were still paying dividends. So an equity research analyst gets up and asks a very sensible question, which is for a change, good. Right? He asked the CEO, do you plan to cut dividends? You know what the CEO said? Over my dead body. To which my response would have been, that can be arranged. What kind of CEO gets up over my dead body? What is this? Dividends, you're going to stick with dividends on the verge of bankruptcy? But that tells you how sticky dividends are and why top managers don't even want to touch them. Are they affected by tax laws? Of course. And in the US, dividends have been particularly affected by tax laws because for 100 years, from 1913, almost 100 years, from 1913 to I think 2000, dividends were taxed more highly than capital gains. Okay? I'll tell you, in 1999 when I filed taxes, on my dividends I paid ordinary income taxes, which that year was like 40% or so. On my capital gains, I paid a 20% tax rate. So when you looked at dividends versus capital gains, dividends were taxed more highly than capital gains. In 2000, for the first time in almost a century, in 2001, the Tax Reform Act brought the tax rates together. So if you look at that tax change, basically it brought dividends back into sync. And you saw companies in 2002 and 2003 start to pay dividends for the first time simply because the tax laws had become more favorable. But that tax law, to get it passed through Congress, shows you the contortions you got to go through, came with a 10-year sunset clause. You know what that means? At the end of 10 years, the entire tax law would cease to exist and you'd revert back to the way tax laws were in 2002. Only Congress writes stuff like this. The assumption was, over 10 years, you'd think, we'll figure something out. Last quarter of 2012, guess what? They still hadn't figured things out. So at the last quarter of 2012, you started approaching what was called a tax cliff, which is everything was going to revert back to the way it used to be in 2002, which meant that dividends would now be taxed at 40% again, and capital gains would be taxed at 20%. So companies were looking at the cliff saying, oh my God, this is all going to change. And the last quarter of 2012, you saw companies paying out dividends like crazy. Las Vegas Sands paid huge dividends, dividends they couldn't afford. Why? Simply because they knew the dividend tax policy would change in the next quarter. So when you look at tax law changes, you're going to see it affected, if not how much cash is returned, in what form. I'm going to show you a table that looks at dividend payouts by parts of the world. And Australian and British companies are among the largest payers of dividends in the world. You know why? It's not even that they have share buybacks, but in the UK and Australia, here's what you're allowed to do as a taxpayer. When you receive dividends, you're allowed to claim a credit for taxes that the company paid on its income before it had to pay the dividends. So let's say the company has a 30% tax rate and you have a 28% tax rate. Your dividends are tax-free. So I've created a tax law where if I pay dividends, you get it tax-free, but if you get capital gains, you might get taxed at 15 or 20%. So whatever country you're in, you can actually see differences in tax laws can affect how much get paid out in dividends. There are parts of the world where dividends are tax exempt and capital gains are taxed. There are other parts of the world where dividends are taxed and capital gains are tax-free. The parts of the world where both are tax-free. So it's a complete mishmash, but the dividend policy in countries will reflect the tax law. Yeah.
Is there double taxation in UK and Australia where they pay income tax on the income of the companies and then there's a dividend distribution tax?
No, that's another. Chile has a dividend distribution tax. So basically, the double taxation is actually for investors. The US has double taxation. Here's why. When I receive a dividend from a company, it comes out of after-tax income, right? So the company paid, let's say, a 30% tax rate. It took the after-tax income, it paid me dividends. What does the IRS then do? It comes to me and says, I want more taxes. I understand the IRS wants a lot of taxes, but you're taxing my money twice when I receive dividends. It is to stop that the UK and Australia created this tax credit. So you always get taxed on income that is paid out as dividends. But in this case, you get taxed only once if you're in the UK and Australia. So countries have devised these strange tax laws around dividends. Okay? And those strange tax laws can affect dividend policy. Chile a few years ago did some really strange things with dividends. You get a chance to go back and read it, and kind of created huge consequences for dividend policy. Because the taxes that companies paid on the amount they paid in dividends, and maybe this is what you're talking about, was different than the tax rate they paid on retained earnings. It was a very ill-advised effort to make companies reinvest more. They said if we tax people on how much, so what they got was what they wanted. Companies reinvest more. The wrong kinds of companies were reinvesting more. Which brings me to what I think has been the biggest change in dividends. And this has happened primarily in the last 40 years. When I did my MBA, the dividend policy chapter was entirely about dividends because 95% of what was returned to shareholders in 1981 took the form of dividends. If there were stock buybacks, they were unusual. Very few companies did it. Somewhere in the mid-'80s, things started to change. You started to see companies shift away from dividends into stock buybacks. And you can see it in this graph. The green is the dividends. So starting in about around 98, you start to see buybacks start to exceed dividends. And by the time you get to the last decade, 2/3 of the cash returned in the last 10 years has taken the form of buybacks as opposed to dividends. This is not a passing phenomenon. This is a phenomenon that seems to have built up over time. Increasingly, companies, when they choose to return cash now, have chosen to do it in the form of buybacks. And there's huge political debate about is this good, is this bad, but it is what it is. Companies have chosen. And it's not just the US. If I showed you what the numbers look like globally, you're starting to see this happen not just in the US, you're starting to see it happen across the rest of the world. Canada, for instance, 41% of the cash returned last year took the form of buybacks. This is not just purely a US phenomenon. Even in, if you take India, 26% of the cash returned last year took the form of buybacks. That surprised me because you don't hear about the buyback debate, but increasingly around the world, companies seem to be shifting away from dividends to buybacks. So I have a question. What's causing this shift? This is a huge shift. I mean, it's affecting the way we invest. It's affecting the kind of metrics we use to look at cash. What's causing the shift away from dividends to buybacks? Yes?
Market volatility would cause a shift in buybacks because of the stickiness of dividends, so the companies would prefer to be able to suspend a buyback policy, whereas dividends...
Let's take the volatility part. You're right. Is it market volatility or earnings volatility you're talking about? Because you don't pay dividends out of market prices, you pay them out of earnings. So one is that you say, so what's caused earnings volatility to increase? Because clearly this has got to be something that's built up. It's more now than it used to be. So what do you think's made earnings more volatile over the last 40 years than before? I mean, yes. One is globalization has a consequence. 40 years ago, if you asked me to list out 100 companies with really safe and solid earnings, I could list off 100 easily. Because there were companies that had nice local markets, they dominated, they got earnings, they were predictable and stable. that is getting increasingly difficult to find because with the globalization, you're essentially getting competition, not just from outside, but from new startups. So one is, one is globalization. The second is disruption, right? Increasingly, businesses we thought were immune from being disrupted are being disrupted. So the first is increased earnings volatility. What else? What else is causing the shift to buybacks? Could management, the way management gets compensated, affect how you return cash? In the 1990s, one of the things we noticed was an increasing number of companies shifted not just to stock-based compensation, but used options, right? If you're managers and you get rewarded with options, how are options structured? You get the right to buy a stock at a fixed price, right? So you want the stock price to go up. You have a choice of paying either a huge dividend or buying back stock. Let's say you pay a huge dividend. What's going to happen to your stock price the day the dividend gets paid? It's going to drop by roughly the amount of the dividend. We're going to look at this phenomenon called the X. It's not bad, it's not good. It just basically means that if I pay a $5 dividend on a $25 stock, the stock is going to drop roughly $5. Now if I reward you with options, you can already see now why this might tilt you away from dividends to buybacks. In fact, one story that was told in the 90s was this is what's causing buybacks to increase is because managers are being compensated with, and it sounded really good. But here's the reason the story is starting to get weaker. In about 2006 or 7, when accountants changed the way they accounted for options, where they made companies count the cost of the options, companies increasingly shifted from options to restricted stock units. And in restricted stock units, while the stock price drops, you also collect the dividend. So you no longer have the same kind of phenomenon. I'm going to be hurt if I don't use it. So you're actually going to collect the dividend because the restriction is on liquidity. You can't trade the stock, you collect the dividend. So you should have started to see at least a partial pushback on buybacks if management compensation was the primary reason. Could the composition of your investors affect how you return cash as well? Because that's the third story that's been told. It's 40 years ago, investors wanted dividends. They were long-term investors. Today, you have pension funds and activist investors and hedge funds that want to collect price appreciation. Maybe they're pushing for more buybacks because it allows them to cash out in their portfolio and not hold on. It's a weak story, but the composition of investors has changed. There are far more hedge funds and activist investors. Maybe they have shorter time horizons and they would rather collect their money in buybacks. But what I want you to think about is you'll hear a lot of conspiratorial stories about buybacks. It's almost like CEOs of the S&P 500 companies gather together in a room and say, how much cash can we buy, how much can we buy back this year? Because these stories are built on premises that don't really hold up. I mean, you're saying, what about the tax? Remember, the tax disadvantage of dividends has actually decreased in the last 40 years relative to what it used to be. So on a purely tax basis, we should be seeing more dividends now than before. And the fact that we're not seeing it indicates that something fundamental has changed. And I think the earnings volatility story is, I think, the key to unlocking it. Yes? I'm sorry? Increasing earnings per share, but that's always, again, if any story you tell, it was true before 86 and it's true after 86, you got to then finish the story by saying, why do people care about more EPS now than they did before? Maybe again, it's got investor bases who care about per share numbers who are, So it could be that investors now care more about per share numbers, that analysts are focused on per share growth and that's why you're doing the buybacks. Okay? But it's creating consequences that we're still dealing with. First, it's ravaged book value at companies. Remember the return on invested capital you compute for your company? It could be a total lie, and here's why. If your company's been buying back large amounts of stock, every time you buy back stock, what happens to your book equity? It decreases. In fact, because the market equity is often 3 or 4 times the book equity, if I buy back 20% of my stock, my book equity could become 0. Apple buys back 12% of its stock, its book equity goes to 0. So when I compute return equity, I get an infinite number. It's making book equity pure fiction. 1 in 8 US companies now has negative book equity. So if your companies, some of your companies have negative, don't freak out. You have lots of company. And it's happening partially because of these huge buybacks. It's also going to mean that old-time value investing strategies, which were built around dividends, are now no longer working. Have you heard of the Dow dogs? There's a strategy where you buy the 4 stocks in the Dow that have the biggest dividends. It's a very old, it's been around like 50 years. And supposedly it works. It might have, but it no longer does. And here's why. If most of the cash being returned by companies takes the form of buybacks, what's the point of even looking at dividend yields? But so many value investing strategies are built around dividend yields. So this has consequences that spill well over dividend policy. It goes into investing, it goes into valuation. The dividend discount model, oldest discounted cash flow model around. You try that for most companies. What's the dividend discount model value for Google? It's 0. And this could be a company that actually returns a ton of cash in the form of buybacks. So it changes the way we think through these numbers. Question?
The equity it doesn't matter through dividends or buyback. If the equity is negative, it means the company has given back more money than it was.
The point though is you do buybacks in much larger quantity. The dividends would have been staggered out over time. So
It's not healthy either way.
either way, I don't know whether it's not healthy. If you're a declining company, what do I care that your book equity turned negative? I want you to give the cash back. So by itself, there's nothing healthy or unhealthy about book equity. It just means book equity means very little. So I'm very, very leery of investment strategies built around book equity because it means less. So if you're pushed on this, why are companies buying back more stock? I'll give you my favorite explanation for it. It came to me. My daughter, she's now 23. When she was 7 or 8, I had to take her to a birthday party. She gets in the back seat, straps herself. She was tiny, so she still had to be in a car seat at the age of 7 or 8 because her weight was too low. She strapped herself and she demanded that I turn the radio on to Z100. If you ever listen to the station, I think they play the same song all day long. You know? And she's a very demanding 7-year-old. Even at the 60 pounds, she was very intimidating. So I tried to, can we listen to jazz? She said, I don't want to listen to that whining. So I turned on Z100. The music comes on. I have no idea who's singing. And between songs, the DJs come and talk to each other. And they start talking about hooking up. And to show you what happens after 25 years of marriage at that point, I had no idea what they were talking about. And then my daughter from the back seat starts explaining to me what hooking up is. And part of me is in shock that my 8-year-old daughter is explaining what hooking up is. And the other part is saying, this is a great way of explaining why companies are buying back stock. I mean, here's the analogy. When you pay dividends, it's like getting married in good times and in bad times. For the rest of your life, you're stuck. It's sticky. You can't walk away. Buybacks are like hooking up. I don't even know your name, but it was nice. No, move on. So companies no longer want to get married to their investors. That's what the old companies look like, is you had investors, you were married to them, you agreed to dividends for the rest of your life. In good times and in bad. Hooking up is a lot more flexible. So I don't know whether this is healthy or not, but it is what it is. And we have to build that into our investment strategies. You cannot invest in a company based on what it did last year anymore. You've got to make your own judgment on what it can return in the future. And finally, if you look across countries, you do see differences. Yeah.
But if they continue doing the buybacks, will that not become an expectation for the investor?
Well, buybacks, you don't buy the same amount. I'll do buybacks every year, but the amount varies every year. They don't buy back the same amount every year. So take a look at the companies, even Apple, which has been you know how much cash Apple has returned in the form of buybacks in the last 5 years? $200 billion. $200 billion. This is a company that's managed to return $250 billion over the last 5 years and has seen its cash balance increase by $100 billion. It's truly got a cash problem. It's got too much cash coming in. Companies would kill for this. $200 billion. But it returns different amounts every year. That's the difference between dividends and buybacks, is buybacks, the commitment is not there. You basically pay out a lot in good years, And if you're an oil company, you do buybacks in a year when the oil price is 100, the oil price is 40, you don't do buybacks. People don't come and put pressure on you. It's not the same kind of commitment. In fact, it's not a commitment at all. It just varies across time depending on your cash flows, which in a way is healthier, right? Because what's the essence of equity? It's a residual claim. That residual claim should be large in good years and zero in bad years. So buybacks actually are more conducive to what equity is than traditional dividends. Traditional dividends have never made sense to me. Why would you take a residual claim and promise to pay $3 in dividends every year for the rest of eternity? Okay. So buybacks, I think, make sense from an, but it is, I mean, today, and this is a phenomenon that is going to go, it cannot be stopped. You can pass all the laws you want, but you're in a period where flexible dividends are the name of the game, because companies cannot survive with the kind of fixed dividends they did in the old ages. And finally, there are differences in dividend policy across countries. One reason is differences in tax laws. The other is differences in corporate governance. And I threw in Russia here to illustrate that fact. Russian companies return very little cash to their shareholders. We should be putting more pressure on Russian company managers, right? I would strongly advise that you not do that, especially if you live in Russia or go to Russia. You go to Moscow, you try to put pressure on a Russian company, you might not come out of Moscow. So if you have weak corporate governance, guess what you're going to see? You're going to see companies accumulate cash, and their response is, what are you going to do to me? The stronger corporate governance becomes, the more cash you're going to see returned. So differences in tax matter, but differences in corporate governance also matter. So I'm going to talk about two measures we use for how much companies pay in dividends. And I'll talk about what they're measuring and what they're missing. So the two ways we've traditionally measured what companies pay out in dividends, the first is the payout ratio, where you take the dividends and divide them by the earnings, a percentage of net income that you're paying out as dividends. Okay? So I'm going to show you what that statistic looks like across companies, and why that statistic might be a misleading number when you're looking at how much cash is my company returning. Traditionally, that was your mechanism for, if this is what's returned, the rest is being reinvested. So the second is the dividend yield, where you take the dividend and divide by the market price. What does that tell you? It tells you the percentage of your return on stock that comes from dividends. The balance has to come from price appreciation. So here's what I'm going to do. I'm first going to play some money ball with payout ratios and dividend yields, so you can get a sense of what a typical payout ratio looks like for a company. So I started with global companies, and I computed the payout ratios for all dividend-paying companies. Hold on to that thought. All dividend-paying companies, the median payout ratio is maybe 30 to 40, 30, around 30%, 35%. The median payout ratio. There are companies that pay out more than 100% of their earnings in dividends, at least in 2018. Some of those companies, you can explain it because they just had a bad year, and because dividends are sticky, they're continuing to pay dividends, hoping earnings bounce back. Some are paying more than 100% because they're liquidating themselves, they're making themselves smaller. And some are paying more than 100% because they're downright insane. They're just stuck in a dividend policy and they don't know how to back out. So there are dividend payout ratios. Dividend payout ratios obviously cannot be less than 0%. And you can see the median, when I compute payout ratios by region, I told you that Australian companies pay out a heck of a lot in dividends. Australian companies collectively return almost 75% of their income in dividends. It might reflect the tax laws being tilted towards dividends. But look across. But remember how I described it. I said the median payout ratio among dividend-paying companies is about 30%. You know what? Here's a nice trick question for you to ask other people when you interview them. Ask them, what's the median payout ratio for a U.S. company? You know what the right answer is, right? There are 7,200 U.S. companies. 5,000 pay no dividends. So what's the median payout ratio for a U.S. company? Median is the middle of the distribution. It's 0%. The typical U.S. company no longer pays dividends. And the typical global company is getting very close to exactly the same statistic. So when you look at these numbers, remember this is just the dividend paying part of the population, but it's becoming smaller and smaller. And here's what's happening. The companies that pay dividends are companies that initiated dividends often 20, 30, 40, 50 years ago. The companies that are returning cash now are increasingly just shifting to almost entirely a buyback amount. So if you wanted to kind of get a cleaner look of how much is being returned, you know what you should be doing, right? Instead of dividing dividends by net income, what should I be looking at? Dividends plus buybacks divided by net income. Last year, the S&P, if you looked at just the S&P 500 companies, their payout ratio was about 35%, very close to median. But they returned 90% of their earnings back to shareholders, because I include buybacks as well. So maybe all these ratios have to be adjusted to bring in buybacks as well, because if you just focus on dividends, you're focusing on a small piece of the puzzle. When I look at dividend yields, I get a similar result. The median dividend yield for a company today is about 2 to 2.5%, much, much, much lower than it was 20 years ago, 30 years ago, 40 years ago, which drives some value investors nuts. They say, hey, this shows you the market's gone crazy. But there are two pushbacks. One is the dividend yield looks at only the percentage of your stock that doesn't count the buybacks. You know what the other pushback is? What's the risk-free rate now? About 2.5%. You're going to see dividend yield reflect where risk-free rates are simply because of opportunity cost, right? If the T-bond rate is 8%, you can have a dividend yield of 6%, and you're not going to look strange. But if T-bond rates are 2.5%, I'm not going to find too many stocks that have 6, 7, or 8% dividend yields. And among the stocks that have those really high dividend yields, be very careful. These are mostly basket case companies that have no business paying dividends. The market prices collapse, but they're continuing to pay dividends even though they shouldn't be. Any value investing strategy built around just picking high dividend yield stocks, that's where you're going to end up. So payout ratios and dividend yields reflect the old-fashioned view of this is the way you return cash, it's dividends. Maybe both these ratios need to be adapted or adjusted for the buyback. So when you look at your company, compute the payout ratio and yield, the traditional way. Don't be surprised if you get 0 on both, if your company doesn't pay dividends. But before you decide my company is returning no cash, look to see how much it returns in form of stock buybacks. That's going to give you a much fuller picture of what your company is doing. So here's my first way of assessing how much companies should return. Remember with capital structure, I looked at where you are in the life cycle. And you told me where you're in the life cycle, I guessed how much debt you should have. Well, I could do the same thing with life cycle, with dividend policy. If you have a startup, how much should you pay in dividends? This is an easy one. 0. As you're a growth company, what's happening? You're growing, you're starting to make money, but you still have you shouldn't be paying dividends. It's as you mature as a company that your capacity to return cash increases. Whether you do it in the form of dividends or buybacks is up to you. But your capacity to return cash will increase as you go through your maturity. And as you go into decline, it should actually go into hyperdrive. Why? Because if you're declining, what are you trying to do? You're trying to liquidate your company over time, which means you're returning more cash than's coming in to make your company smaller. So if you can tell me where your company is in the life cycle, I can guess whether your company should be returning a lot of cash or not. Not very scientific, not very quantitative, but actually a very effective way of thinking about dividend policy. And in fact, when you look at the numbers, it's backed up. Yeah. So when you looked at dividend yields versus how much growth the company is expecting, as you expect more and more growth in a company, you tend to see less paid out in dividends, which makes sense. But not all companies do the right thing. You'll sometimes see growth companies trying to pay dividends when they shouldn't be, or mature companies holding back on dividends. But looking at where they are in the life cycle, at least will get you a sense of are they being mismatched. So let me list my 5 companies, show you what the numbers look like, purely on dividends, and then we will bring in the buybacks later in the picture. So when I look at Disney, Vale, Tata Motors, Baidu, and Deutsche, let's start with the easy one. Baidu, everything is 0. They pay no dividends. Disney had a dividend yield of 1.09% if I look at just the last 12 months, but given that numbers can jump around, I looked at the last 5 years, and it's actually pretty close. What I have as yield and payout in the last 12 months is very close to what the yield and payout ratio have been over the last 5 years. If you look at Tata Motors, the dividend yield and payout ratio, again, are very similar if I look at last year versus the last 5 years. But if you look at Vale and Deutsche Bank, and I look at just last year's numbers, you get crazy looking numbers, right? The payout ratio is well above 100%. The dividend yields are huge. And that in a sense tells you why yields and payout rate, because if you look at the 5-year average, it's much lower. So did they quadruple dividends in the last year? What's happened here? What's caused the yield to go up so much? the stock price collapses. The main reason for yields and payout ratios changing is not because the dividend is changing, but because the market knows you're in trouble. So when you see big jumps in dividend yields, it's almost never because your company increased dividends because the stock price has collapsed. Keep that in mind as to one of the danger signs in buying high dividend yield stocks. So I'm going to list out 3 schools of thought on dividend policy. They kind of span the spectrum. First school of thought says if there are no tax disadvantages to investors associated with dividends versus capital gains, you're taxed the same way on both, and there are no transactions costs. You can go out and issue equity if you want to without paying issuance fees and transactions costs. It does not matter how much you pay in dividends. Does that sound familiar? Didn't we have something else that did not matter? About 3 sessions ago, it does not matter how much you borrow. That's Miller-Modigliani 1. Miller-Modigliani 2 says it doesn't matter how much you pay in dividends. If we lived in a Miller-Modigliani world, this class could end after session 15. Right after the investment analysis, you are done. And it's actually not a bad way to start your analysis. In a world with no frictions and no taxes, it doesn't matter how much you pay in dividends. And I'll give you the basis for the argument. It's a surprisingly logical one. The second school of thought was created in the US in the second half of the last century. Remember, in the second half of the last century, dividends were taxed at a very high tax rate. Capital gains were taxed at a much lower rate. And there was an entire school that developed saying companies should stop paying dividends for a simple reason. When you pay dividends, you cost me a 40% tax. But if you could take that same cash and provide price appreciation instead, it's pretty easy to kind of move it around, I'd pay only 20% tax. So you say, why would companies? So the second school of thought is just stop paying dividends because dividends have a tax disadvantage. And there's a third school of thought says the investor is always right. So if the investor wants more dividends and you have those investors holding your stock, you should pay them more dividends. If your investors are the kinds of investors who don't like dividends, then you should stop paying dividends. This is very convenient because there are 3 schools of thought that back up no matter what you do as a company. The first school says, if you don't know what you're doing about dividend policy, it doesn't matter anyway. It's a Miller-Modigliani school. The second school says, if you're cutting dividends, great. The dividends are bad school is right behind you. And if you're increasing dividends, the third school of thought says, that's good because your investors like dividends. All 3 schools of thought can't be true for the same company at the same point in time, but they have elements of truth that cut across companies. In fact, I'm going to take what I see in these 3 schools and kind of summarize what I think would be a sensible conclusion. If your company has lots of cash coming in from its projects and does not have very good investment opportunities, I think you should be returning more cash to your shareholders. Make sense? If your company doesn't have very much cash coming in because they're a growth company, the projects have just started to kick in, and they have lots of investment opportunities, you have no business returning cash. So if I can somehow measure how much cash a company is generating and how good its investment opportunities are, I should be able to tell you where in this matrix you will fall, whether your company should be paying out a lot, paying out very little, or paying nothing at all. So I'm going to try to come up with measures of how much a company can return and how good its investment opportunities are. That's going to become the basis for deciding whether companies should be returning more cash, less cash, or we're just going to leave them alone. So let's start with the dividends don't matter school of thought, the Miller-Modigliani. Okay? The Miller-Modigliani argument is very simple. It says, look, let's say you're a company and you should be paying $100 in cash and you pay nothing. It doesn't matter because what happens to $100 in cash you didn't pay, it goes into your cash balance, and that cash balance then becomes a higher stock price. So in a world where you don't care about whether you get dividends or stock buybacks, all it will mean is that instead of getting your expected return of 10%, 3% from dividends and 7% from price appreciation, you get all 10% from price appreciation. So if you pay too little in dividends, not a big deal. It just passes through to the bank. Say, what if I pay too much in dividends? Won't I have to turn away projects? In this world, you don't have to, because if you pay, let's say you could pay 100, you decide to pay 200. That's bad, right? But then if I could go out and raise 100 in new equity and still take the same projects, it is true you will be receiving this huge dividend, very little price appreciation, but you're going to be okay with it. You'll have dilution, but you don't care because you get a 12% dividend yield. You get the same return, whether I pay no dividends, exactly what I should pay in dividends, or twice what I should pay. Because whatever one hand takes away, the other hand will give back to you. But in this world, You and I as investors should be indifferent between dividends and price appreciation, and companies need to be able to raise that extra cash in case they pay too much in dividends. So in some companies, you could argue that maybe too much attention is being paid to dividend policy, because if you live in a world where investors are pretty neutral about dividends versus capital gains, and you also live in a world where your company can raise capital pretty easily with very low issuance costs, maybe we should spend 5 minutes on dividend policy and move on, because it really doesn't have that much of an impact on value. The second school of thought is very simply based on different tax rates. So I talked about the US tax code. This is actually the tax rate on dividends, and the bottom line is the tax rate on capital gains. Going all the way back to 1916. You know why I started in 1916? That's the year the Supreme Court actually decided that a federal income tax was legal. Because until 1916, states were supposed to have, so an income tax on, so that's the start of the period. So you can see for initial period, capital gains were not even separated from dividends, but starting in about 1920, you start to see the tax rate on dividends be much higher. So 1979, so let's say 1960, the highest marginal tax rate was 90%. So if you receive dividends, you might as well just mail the check off to the government saying, what's the point? Okay? Capital gains were taxed at 25%. The difference was huge. Okay? That difference prevailed until 1981 with the Reagan tax cut, but it continued. It's only starting, there was a brief period in 87 where Congress rationalized the tax code, and they said never again will we visit it because we fixed it forever. They revisited 1 year later, made the difference show up again. But since 2003, you see that dividends and capital gains have been taxed at the same rate. And this is US specific. You do this for every country, you're going to see dividends and capital gains being taxed differently in different parts of the world. But for much of the last century, you could argue that US companies were hurting their stockholders by paying out dividends. Well, it depends on who your stockholders are though, right? Are they wealthy stockholders who pay high, the 90% tax rate is after all the highest marginal tax rate. Maybe the older people who receive Social Security don't pay taxes on dividends at all. So one of the questions it will be nice to be able to answer for your company is, who owns stock in my company? What do they think about taxes on dividends versus capital gains? And there's actually an interesting way you can get a snapshot on this. When you look at dividends, there are there are actually 3 dates associated with dividends that are worth looking at. The first is the dividend declaration day. That's when the board of directors gets together and tells you what the dividends are going to be next year. So if they're going to increase dividends, you'll see the news story the next day in the Wall Street Journal says company A announces it's going to increase dividends by 20%. That's the day where the market reacts to the information. You're going to see the stock price go up and down depending on what the board decides. 6 weeks later or so, you have the ex-dividend day. What's the significance of the ex-dividend day? If you own the stock by the ex-dividend day, you actually get the dividend check. If you buy the stock after the ex-dividend day, you don't get the dividend check. So on the ex-dividend day, there's no news that comes out, but it's significant because if you buy the stock by the end of the day, you get the dividend, and if you don't get the dividend. So part of you is saying, I always buy before the ex-dividend day. So how does the market adjust for this? On the ex-dividend day, the stock price tends to drop to make easy profits go away. But how much will it drop is significant because it depends on what the taxes are. So let's play a game. Let's suppose we're all stockholders in a company. We bought stock in this company 5 years ago. Why 5 years ago? Because the way capital gains taxes work is you have to hold the stock for at least a year to get capital gains taxes. Otherwise, it's all ordinary income. The difference dissipates. So we all bought the stock 5 years ago, and we paid a price. Let's say it's P, so for general purposes. Tomorrow is going to be an ex-dividend day. Do we know what the dividend is going to be? Remember, that was set in the declaration day 6 weeks ago, so there's no uncertainty about the dividend, so we know the dividend is going to be tomorrow, and we know the amount of the dividend. And we face a choice, each of us. We can either sell the stock before the ex-dividend day and give up the dividend, or wait through the ex-dividend day and collect the dividend. So let's see what our cash flows would be if we did it before. If we sold just before the ex-dividend day, we're going to get that price, PB, and we're going to have to pay capital gains, but we have no dividend. So my cash flow is going to be PB minus the capital gains taxes. If I wait through the ex-dividend day, I get a different price, BA. I'll have capital gains on that price, but I'll also collect the dividend net of my ordinary taxes. So for each of us, this equation holds. Let's say for every one of us, the cash flows from selling before are greater than the cash flows from selling after. What's going to happen? There's going to be a wave of selling just before the ex-dividend. If there's a wave of selling, I'll push it's unstable. If for every one of us, the cash flows from selling after is greater than the cash flows from selling, none of us will trade before, that's also unstable. So here's what has to be true. For most of us to stay on the sidelines, these cash flows have to be, we have to be indifferent between selling before and selling after. Which means if I work through it, on the ex-dividend date, and the equation got, the price drop divided by the dividend has to be a function of how I get taxed on ordinary income versus capital gains. Ordinary income here being dividends. So here's the general proposition. If the typical investor in your company is indifferent on a tax basis between dividends and capital gains, they get taxed the same way, the dividend drop will be roughly equal to the dividend. If your typical investor gets taxed at a much higher tax rate on dividends than on capital gains, on the ex-dividend day, there will be a price drop, but it will be less than the dividend. So there's $1 dividend, your stock price will drop by only 80 cents. Because to you, on an after-tax basis, 80 cents in capital gains is roughly equal to $1 in dividends. And if your typical investor, this is true in some parts of the world, gets taxed at a higher rate on capital gains than on dividends, you can actually get a price drop that is higher than the dividend. So while I cannot figure out what your tax rates for investors in your company are, I can look at what happens on the ex-dividend date to your stock and back out from it whether the investors in your company, at least collectively, like dividends, dislike dividends, or indifferent to dividends. Okay? So I'm going to look at the dividend you pay, I'm going to look at the price change, and I'm going to look at that ratio. That ratio is close to 1. I come to the conclusion that your dividends and capital gains, at least for investors in your company, are being taxed at roughly the same rate. If the price change is less than the dividend, I'm going to conclude that dividends are taxed at a higher tax rate than capital gains, and there's a tax disadvantage with dividends. If the price change is greater than the dividend, then I'm going to conclude that dividends are actually taxed at a lower rate than capital gains. So by looking at the ex-dividend day, I'm getting a sense of what kind of investors you have in your company. So this is actually, I mean, when people first came up with this metric, it was like in the late 60s, they started looking at US stocks. And the first studies came out in like 1970. Elton and Gruber, two professors studied, this is one of the most famous, most cited studies, looked at what the typical change in stock price was as a percent of dividend for US stocks. And between 66 and 90, the ordinary tax rate was 70%. For the highest taxed individuals, the tax disadvantage was huge. They found that dividend, the price drop on the ex-dividend day was about 78% of the dividend, consistent with dividends being taxed higher than capital gains. That study was redone after the tax code changed in 1980, and it still kept the difference, but the difference became much smaller. Dividends were taxed at 50%, capital gains at 20%. They found that the price change became 85% of the dividend. And then they got to 86 or 90, one of those brief periods where the tax rates actually converged, and they still found that the dividend drop was, the price drop was still less than the dividend. And that was, when they found that, they were actually a little puzzled, not the same, but they said tax rates are the same. Why are dividends still being treated as more of a tax disadvantage than capital gains? So I'm going to throw that question. Let's say dividends and capital gains get taxed at the same rate, which is what they are now. Why might you still prefer capital gains over dividends? What's the tax advantage you get when you receive? Capital gains, what does that mean?
Means I have to actually sell the stock for this tax incidence. So dividend is a certainty of tax. Capital gains I can choose not to.
Okay, so you get a choice as to when you claim capital gains, right? Because until you sell the stock, you can't tax me. I have things in my portfolio that I'm horrified by the taxes that I'll owe, which is a good thing. Because what's the alternative? They look at everything in your portfolio, it's creating tax losses. You don't want that. But they can't tax me, at least at the moment, on that. Maybe they'll change the tax code, but for the moment, I get to choose when I claim capital gains taxes. You think, so what that you choose? Maybe I'll choose a year where my income is going to be much lower. Maybe I'll wait till I'm 75 and have no income at all. Or maybe I'll wait till I die. Because you know what happens when you die? Of course, when you die, you know what happens. You die. But you know what happens to your portfolio when you die. You're allowed a mark, basically, that passes through. It passes through an inheritance. You don't get taxed until the people who inherit your portfolio actually sell it, unless you have estate taxes. On an income tax level, I can defer taxes essentially for a long time. But dividends, I can't go to the IRS and say, I don't feel like paying taxes. I have to pay the taxes. So there is a timing advantage still with dividends, with capital gains, which means that if you had a choice, you'd rather get your money in capital gains than in dividends. And the studies find it. But this does create a potential for true arbitrage. The fact that the price drop is less than the dividend. And that's the last thing I want you to think about. Let's assume you believe these studies, that the price drop on the ex-dividend day is only 90% of the dividend, and you are a tax-exempt investor. So which investors are tax-exempt? Pension funds don't pay taxes. Endowment funds don't pay taxes. So let's say you're a pension fund. You're tax-exempt. Can you think of a way to make money off this phenomenon? What would you do? I'll give you some choices. You can invest in the stock for the long term. What's that going to do for you? Not much. Maybe you can sell short the day before and try to, but that sounds so complicated. What if you just buy before the ex-dividend day? Hold through the ex-dividend day and sell the day after. Do you see what's going to happen? You're going to give up the 90% of the stock price, but you're going to collect the dollar dividend. And in fact, if you do this in enough bulk, you have what's called dividend capture. Pension funds do this all the time. They'll buy 1 million shares. You're saying, why 1 million? Don't do this on 1,000 shares. It's not worth it. You got to do it in bulk. 1 million shares for $50. It drops by 90% of the dividend. You sell it for $49.10. Your dividend is $1. You make 100,000. You think only 100,000? You do this in enough stocks, it can add up. Just remember that 90% drop is not guaranteed, right? So if you did this on a day the market is down 8%, don't expect the stock to drop only 90%. So if you're going to do this, you've got to do this on enough stocks that it kind of averages out. So next session we'll continue our talk about dividends, but dividends are not on your next quiz. So basically, kind of start to catch up on capital structure, because that will be what we cover in quiz 3.